Just give everyone a minute. Now you can see the slide, right, Sari?
I can, and now ironically it's a little too big, so that's why I'm like, how do I?
Oh, let's just keep it big. It's just easier to read then.
I mean, you can see it's like not fit to screen though, right?
Keep going. Keep going to the next one. No, it fits everything. Yeah, you guys see it fine?
It's showing up fine for me as well.
Yeah, same
Yeah,
here.
no, it's just like it's just zoomed in a little too much. I mean, I think it's okay. It's better that than.
I think it's okay because no text, it's not cutting off any text, so we should be fine.
And all right, now that some more people have filtered in, good morning, everybody. Thank you for joining us today for the MVLS Frost Law Understanding Offers and Compromise webinar. I'm Katie Cardinal, the Volunteer and Member Relations Coordinator for MSATP. Our education committee works diligently to bring you relevant programs that enhance your practice and help you better serve your clients. And today's webinar is running from 11 a.m. until noon. Throughout the session, if you have any administrative questions, please put those in the chat section. And if you have any questions for our speakers, please put those in the Q&A section. To earn full CPE credit for this session, you must answer at least 75% of the polling questions that will pop up intermittently throughout the webinar. There will be a total of 4 questions today, and you do not need to answer them correctly. Simply answering is sufficient. Please welcome our first speaker to introduce us, John Hart.
Hello, everyone. My name is John Hart. I'm the director of the Low Income Taxpayer Clinic at Maryland Volunteer Lawyer Service. We are a nonprofit that works to connect people, specifically within my program, people who are in controversy with the IRS or the Maryland Comptroller and need legal representation but can't afford it. And that mission is carried over similarly to all the other programs at MVLS, whether it be housing or family law or bankruptcy or consumer finance, or an organization that tries to get legal help where it's needed. And we put on presentations like this in partnership with Frost Law to help our volunteers. We are a volunteer-based organization. Any prospective volunteers who might be interested in volunteering with us and sort of helping them develop their practice and getting them ready to take on their own cases and maybe cases with us to help those who really need it. I'm going to put our website in the chat so you can check it out, see if volunteering with MVLS might be right for you. We do let all of our volunteers be the one to decide what cases they take and when, and you can view summaries of those available cases on our website, on our pro bono portal, as well as some more information about, what we do and how we operate. So without further ado, I'm going to hand it off to Zoa and Sunny, who are going to be our main presenters today.
Hi, thanks, John. Little quick introduction. My name is Zoha Sohail. I'm an associate at Frost Law. I essentially focus on tax controversy, so helping individuals, businesses with IRS and state tax issues. So really, we're doing a lot of offers, penalty abatements, trust fund, state and IRS audits, and that's it. I'll let my colleague introduce herself now.
Hi everyone, my name's Sunny Shim. I'm an associate at Frost Law like Zoha. I haven't been here as long as her, but I've been here a decent amount of time, a little over 2.5 years. September of this year will be my 3-year anniversary here at the firm. And broadly speaking, I am a tax controversy associate. I would say for right now, the bulk of my work has been in the collections process of the administrative pipeline. But, broadly speaking, I would say collections is the bulk of my work. But I do things like audits, and in the past I have, not so much now, but I would also do some criminal cases here and there that had to do with tax issues. So, I would say collections right now is my bread and butter, including stuff like the offer and compromise process that we're going to talk about today. So, yeah, without any further ado, why don't we let Zoha get us started?
Yeah, let's get started. All right. Thanks for helping me, Sunny, with the slides. Next one, almost there. All right, perfect. So let's get started. So first, we're talking about offer and compromise. What is an offer and compromise? A question that we get asked all the time. I think my clients really love this question. So offer and compromise essentially is an agreement between the taxpayer and the IRS that allows taxpayers to resolve their tax debt for a lower amount than what is originally owed. So it's essentially a program that's designed to help taxpayers that are really struggling to pay their debt in full due to financial hardship. And there's a lot of more things. So let's get started. So next is, why would we propose an offer in compromise? So there are several reasons why offer in compromise, like filing an offer in compromise, would make sense. These are just, most important ones, and we'll talk about a couple. So obviously, filing an offer in compromise may result in a significant reduction in your client's tax burden. So if they're eligible, which we'll talk about later, filing an offer would make sense because it would reduce their liability. Filing an offer in compromise also prevents the IRS from initiating a levy action. What is a levy action? Any enforcement action. So if you're not in an agreement with an IRS, not in a payment plan, filing an offer can protect you from like a wage garnishment, a bank levy. So that's great. Also, if you can file an offer in compromise to correct an IRS examiner's mistaken interpretation of law. If a taxpayer is suffering from economic hardship, filing an offer in compromise is a great tool, and you can actually argue and win, especially if you're in an economic hardship, and which we'll talk about that later as well. Make sure that all relevant evidence in a case has been examined, including new evidence. That's also another reason. Let's move on to the next slide. Okay, now the most important thing, I know offer in compromise sounds like an amazing program, which it is. It's just unfortunately not for everybody. So one thing we want to make sure you understand is who is eligible to file an offer in compromise. I'm sure everybody would love to, especially those who owe tax to the IRS, but it's not as easy as it seems. It's a very serious program. IRS takes it very seriously. So you've got to be eligible in order to file an offer in compromise. So let's talk about the quick eligibility requirements. Number one, if you want to file an offer, you must first have all your tax returns filed prior to submitting an OIC application. So if you're submitting an offer, let's say right now in tax year 2025, you want to make sure you're current up until 2023 you could file an extension for 24. But what I like to do is I want to make sure we know that whether our clients will owe for tax year 24, have they paid that in full or not? So you want to make that determination, even if you're filing an offer right now in tax year 2025. So also next, received at least one tax bill for a debt included in the OIC. So just like this, I said, if you owe tax for 24, you should file your 24. Let that get assessed by the IRS, receive your first tax bill, so you can include 2024 in your OIC submission, and then you can submit that offer. So next, you must remit all your estimated tax payments for the current tax year. So if you are self-employed or you owe tax that requires estimated tax payments, you make sure that your current OIC department is very particular. They can send back offers after one morning if you're behind on your estimated tax payments. We'll talk about that when we get to that point. Also, you're required to make all your federal tax deposits if you are a business for the current quarter, if the taxpayer is a business owner with employees. Now, what would make you ineligible for an offer in compromise? Case or debt has been referred to the Department of Justice. You failed to file legally required returns before the OIC application. You're subject to an open audit. Taxpayer has an open innocent spouse claim, or you're currently in a bankruptcy proceeding. So these would make you ineligible, and then your offer can be returned. Next, what happens if you file your offer and then you get a preliminary rejection of your OIC application? It can happen. It does happen. There are two main reasons why it can, and that's if your OIC application, which is the fee of $205, you've combined that with another payment, and you've just sent IRS one check, they'll send it back. OIC application fee, which is $205, the $205 has to be a separate check. And you can always memo that check and say, this is just the OIC application fee. This is a non-refundable OIC application fee. And if you are sending a check in addition to this, which could be either your lump sum payment or your first periodic payment for that offer, that will be a separate check. Another reason why they can reject your OIC right away would be just history of deliberate non-compliance. So you've either not made your estimated tax payments, you've either accrued a new balance when you submitted an offer, and that will just have them send it back. All right, so next, real quick, is significant exceptions for low income certification recipients. So this is a great tool for anyone that falls in this chart that you can see on the screen. So we're here where the IRS talks about looking at your household yearly income along with your family size. So if you are in a condition that actually falls in one of these categories, you actually do not have to remit the OIC application fee that you are required to give otherwise at the time of submitting your offer. Also, you are not required to remit periodic payments while your offer in compromise is pending with the IRS. Also, applications cannot be rejected solely on the basis of the amount offered as long as you're in this category. So that's great for people who do not have enough yearly household income. They are great candidates for offer. And if they fall under these requirements, they actually do not have to pay an OIC application fee. All right, let's get started on the main topics. Like we talked about what is an offer. Now it is the types of offer. There are 3 types of offer, and it will depend what works best for you depending on your financials. So number 1 is offer and compromise based on doubt as to collectability. Number 2, there's offer and compromise based on doubt as to liability. And number 3 is the ETA offer, which is the offer and compromise based on effective tax administration. And we'll walk you through each one of these. All right, so the first is doubt as to collectability. This is essentially where a taxpayer wants to file an offer as long as they're eligible. They're not contesting the liability they owe to the IRS. They know they made a mistake, they were behind, that liability is correct. They're really filing an offer because of the financial hardship, and they don't have the income and assets to pay back. So here, again, you're not disputing the amount of debt owed. This is really used when it's reasonably foreseeable that a taxpayer's financial situation will not improve and they're unlikely able to satisfy the full debt within the statute of limitations. And that's why they're filing an offer and compromise to settle their debt for an amount, for a lesser amount than what's actually owed. So reasonable collection potential must normally consider. So what happens is your doubt as to collectability is based on your reasonable collection potential. Sunny will talk more about it as we proceed further. So what is your reasonable collection potential? The amount collectible from the taxpayer's net realizable assets, again, we'll talk about it more in detail later. The amount collectible from the taxpayer's expected future income, typically the next 3 years. They look at either your future 12 months or 24 months from the date you file an offer. The amount collectible from third parties, the amount that the taxpayer can reasonably be expected to raise from the taxpayer's asset that the government cannot reach. So essentially, when you file an offer, they will look at your income, assets, your 401k. They're going to look at your investment accounts. If you have crypto, all of those will actually be used in figuring out your reasonable collection potential to pay the IRS. All right, next slide. Now, next is doubt as to collectability. Doubt as to collectability is really where you are, again, not able to pay because of your financial condition. Now we're talking about 2 types of payments. How can you make an offer? There are only 2 types of offer. One is the lump sum payment and one is periodic payment. It's a great option depending on your financial situation. So lump sum payment is where you're actually paying 20% of your offer amount at the time of filing an offer. So your attorney must be very careful. If your offer is large, your 20% will also be large. So you want to make sure you have a decent conversation with your tax attorney, depending on if you're a good candidate for doubt as to collectability, whether you should pick lump sum option or not. For someone who owes less, and your offer is less, 20% would be a great option because you can put that down as your 20%. And then if your offer gets accepted, you then have 5 months from the date of acceptance to pay that remaining balance. So that's essentially is what a lump sum payment is. Taxpayer, even for the lump sum payment, you must still submit the OIC application fee, which is non-refundable. That is the $205 that we mentioned earlier. If the offer, staying on the lump sum part, if the offer is deemed not processable, returned, rejected, the payments, including the deposit that you paid, they're all non-refundable. They will go, of course, towards your debt, but it's not that just because they returned it, they rejected it, they'll send all that back. They do not. That 20% will be applied towards your IRS debt. All right, the second type of offer is a periodic offer. Periodic offer allows for an offer to be paid in 6 or more installments. You could do a maximum of like 24 months, and you can make like 23 periodic payments, with the 24th being the one that you're sending with your OIC application. The taxpayer must submit the first proposed installment agreement payment with the offer. Like I said, the taxpayer must continue to submit monthly payments while while you're waiting for the IRS to examine the offer. So you submit your offer. Your offer does not get picked up by the OIC department right away. Just know that there's going to be a delay. Given the backlog, it can take at least, somewhere between 5 to 6 months to just even hear back from an IRS and have an IRS OIC examiner assigned to your case. Even then, while you're waiting, you must still make your periodic payments that you've agreed to on your offer in compromise application. Again, if the offer is deemed not processable, returned, rejected, the installment payments that you are making every month are non-refundable, but again, they will be applied towards your debt. So you're not technically losing it in case your offer gets returned. Again, even for a periodic payment, the taxpayer must submit a separate OIC application fee, which is a $205. That's non-refundable. Okay. Next is doubt as to liability. So this is a second type of offer that you can do depending on if you fall in one of these three. So number one, you can only do a doubt as to liability for genuine disputes as to the existence or the amount of correct tax under the law. So you genuinely believe that this liability is not correct. IRS made a mistake and I do not owe this balance. And that's where you can then do a doubt as to liability offer and compromise with the IRS. It's also used when the taxpayer has missed time periods due to to dispute the tax during the time limits they're allowed by the IRS or the IRS guidelines. OIC examiner previously made an error, and then you could file a doubt as to liability. New evidence has come into existence that supports a change in prior assessment. So maybe your prior assessment was correct, things changed, where now you feel like you're no longer actually liable for this debt. And you could file a doubt as to liability. Again, doubt as to liability has a very, very small criteria for eligibility, and you really want to make sure that your client is actually eligible to file a doubt as to liability. It's not that common, but it's still a great tool for those who have doubt with their liability. All right, next is my favorite. It is the Effective Tax Administration and ETA offer. It's also not used very much, but it's used when there is no dispute as to the existence or the amount of tax owed under the law, nor as to the collectability from the taxpayer. Meaning here, the taxpayer does have assets and income to pay the IRS. It is used when the collection of full tax debt would subject the taxpayer to economic hardship. So what happens is if there's someone that's old, has a retirement account or a pension account, that's their main asset. So that means they have enough asset that they can liquidate to pay to the IRS to full pay their debt. However, make the taxpayer do that would actually cause significant hardship. Like I gave that example of a retirement account. If that's your only asset, you're old, you are retiring, you will not be working, you need those funds for the remainder of your life. In that case, ETA can be a great offer. It is a little complicated. You want to make sure that you as an attorney would look at life expectancy chart, make sure that you've done that calculation to really see that your taxpayer will not have funds for the remainder of their life based on the IRS life expectancy charts to show. Because again, this is a very difficult offer to go through, and IRS will look at all those reasons, see their age of the taxpayer, look at their assets, look at if they're expected to live for another 17 years or 20 years, will their current income and assets be sufficient for the remainder of their life? But again, it's a great tool for those who are good candidates for an ETA offer. Okay, so before I get started, I do want to mention when you file an offer, your offer can be either returned or rejected. So that's why we want to have different slides for this. We want to explain that to you, that these have different meanings. So let's first talk about what happens when you file an offer and your offer gets returned. An offer can be returned for non-compliance. So returns that you were required to file, you did not file them. Estimated tax payments that you had to make, you did not. Or if you're a business, you're behind on your federal tax deposits, your offer can be returned. Any payments not already processed with the offer will be returned to the taxpayer and will need to be submitted. Next is offer can be rejected. So they can also reject your offer. Just one more thing. When your offer is returned, it's not returned with appeal rights. It's literally just they're sending your entire application back. When they reject your offer, there are reasons they rejected it, and it can come with appeal rights. So why will IRS reject your offer? An offer can be rejected for many reasons, such as the reasonable collection potential is greater than what it is claimed for. So of course, your attorney will submit an offer based on your reasonable collection potential. IRS examiner can review it, and they will think that you basically have more potential to pay than what it's claimed on the offer. The taxpayer has the ability to full pay the liability within the statute of limitations. Again, a test that often people forget to look at when submitting offer and compromise, that as attorneys we should be very particular about. Look at the statute of limitations for each liability. If IRS has 10 years to still collect on these balances, it will make that offer a weak offer because they could still collect it in full within those 10 years on a payment plan. So you want to make sure that you are looking at the statute of limitations before you submit an offer and compromise for your client. Another reason why it can be rejected is just on public policy, they can reject it as well. No payments made as part of the offer will be returned to the taxpayer, right? Next is what happens when when your offer is rejected, it comes with appeal rights, which is great because then it allows you another opportunity to file an appeal. Appeal will go to the Office of Independent Appeals, and you get another chance to really resolve your tax debt with that office. And OIC rejection will come in the form of a letter from the examiner in charge of the case. So they'll mail you that letter, and they can also fax it to you, to your POA, but they are required to mail it as well. The letter will give the taxpayer 30 days from the date of the letter to file an appeal of the rejection. So it's a very important deadline. You make sure you get a letter, you mark it, and it's the 30 days from the date of the letter. The taxpayer will also be required to produce a final asset and income table. It is generally not recommended to appeal every item of the income asset table, rather only appeal items that are actually in dispute. That will help narrow down the focus of the appeal. So one thing I want to mention here is filing an appeal is very important because your appeals officer is going to look at that appeal form, and it's going to look at those items that you are disputing. So therefore, the items that are genuinely in dispute that you do not agree with the offer examiner, you have to make sure that you list all of them on your OIC application form. Okay. I know some questions are coming in. We'll definitely answer them towards the end. So this is how the form looks like. This is form 13711. It is a request for appeal of offer and compromise. This is where you will just fill out your information, your name, your address, your mailing address, your, the tax forms, tax periods at issue, of course, your social. I don't know if we have the next form, Sunny. Let's see the next slide. So, but yeah, we don't have the full form, but really that's just the form that you will fill out. It also has there's another page, you'll list out each dispute. Yeah, we didn't put that, but it doesn't matter. All right, let's move on. OIC forms. I think now I'm going to hand this over to Sunny.
Hello again, everyone. So this is Sunny. I'm going to take it over from here. Zoha's going to wrap up the presentation at the end. So
Yeah.
Thank you, Zoha, for that really helpful primer on the ins and outs of OICs at 1,000 feet level. So now that Zoha has gone over just the substance of what is an OIC, what are the different bases for submitting one, what's the broad procedure, I'm going to go and take a pretty detailed view of the OIC forms that are used to submit the offer and compromise. So the forms are, broadly speaking, the 433A and 433B OIC, not to be confused with the non-OIC 433s that are used. So these are 433A OIC, 433B OIC, and then the Form 656 and the 656L. The 433s are financial statements that need to be filled out. The 656 is just the offer and compromise form itself, where you just lay out the offer that you're making to the IRS. The 656-L is what is used when the offer and compromise is being submitted on the basis of data to liability. Like Zoha said, That is not a typical, that's not a very common basis on which you submit an OIC. So we're not going to go through the Form 656L. We'll just go through the Form 656. So let's get started on the 433s. The 433A OIC is for individuals to fill out and individuals who own sole proprietorships to fill out. So your individual information goes on there and your sole proprietorship information goes on there. The 433B is for all businesses that are not sole proprietorships. So broadly speaking, the purpose of any Form 433, whether it's in the OIC or non-OIC context, is for the IRS to be able to review the form along with the attachments and do a collection potential analysis. These forms can be kind of intimidating for the average taxpayer or individual to undertake. You know, as someone who's an actual tax attorney, when I started doing these forms, they can definitely be a lot. It was definitely a steep learning curve. The more and more I do them, of course, I'm more comfortable with them. You know, but for a lot of taxpayers who encounter this for the first time, it can be a lot. So, you know, I like to simplify and boil it down for them by saying these forms, they are to analyze your collection potential, which just really breaks down to how much equity do you have in your assets and what does your monthly net cash flow look like in terms of what is the delta between your income and your expenses. So these forms are really straightforward, honestly, when you get into it. Here, we're going to start with the 433A. Section 1 is personal household information. Who are you? Who's in your household? What is your guys' indexing information? Where do you live? What dependents do you have? Section 2 is employment information for wage earners for you and your spouse if you're married. So the IRS is not just looking at you, it's looking at your household. So who is bringing in money, how much, what are the expenses for everyone in total? You know, so if you're married and you and your spouse are both bringing in income and splitting bills, it's not the same analysis as if you're just single, you're the only one bringing in income and generating expenses, or you're married, but only you work and your spouse doesn't work, but your spouse brings in expenses. So, you know, employment information for wage earners, this is if you're a W-2, it's pretty straightforward. Where do you work? How often are you paid? Weekly, bi-weekly, monthly? You know, what does your spouse do for a living? Section 3 is your personal asset information, and it starts with, do you have cash? Do you have bank accounts? How much cash do you have on hand? What's in your bank account? What's in your checking? What's in your savings? And it gets into your assets, like retirement assets. Do you have a 401k? Do you have a pension? Do you have digital assets like cryptocurrency? What is the fair market value of said assets and accounts? Down here, you see cash value of life insurance policies. Do you have a life insurance policy with actual cash value? Here, they're typically referring to whole life insurance policies as opposed to term. So then after it goes through your bank account, cash, retirement, etc., it goes into more tangible assets, namely your real estate and your vehicles. So do you own any real estate? If so, what is the information on that? Is it a primary residence? Is it more of an investment property? Do you have multiple properties? Okay, cool. What is the fair market value? What is the appraisal? Do you have a mortgage left? What's the maturity date of that mortgage? And what is the delta, again, between the fair market value and the loan balance left? That is your equity. Similar analysis for the vehicles. What vehicle? Make, model, year, fair estimate of the fair market value. What's the car note? How much is it? What's the maturity? What is the equity of that vehicle? Still in section 3. And then section 3 wraps it up by looking at other assets you might have. Artwork, jewelry, furniture, you know, things of that nature. I will say, broadly speaking, I have had some clients fill that part of section 3 out and say, you know, I have this jewelry or this furniture. But broadly speaking, when it comes to its collection potential analysis, I do not find that the IRS is that keenly interested in stuff like your furniture or your jewelry, unless maybe you have like a really, like you own a Monet, or your furniture, I think it's called Chippendale. It's like really rare furniture that's like priceless. So I guess if you have that, it'd be relevant. But typically the IRS doesn't focus on those things. It's mainly interested in your real estate, maybe your vehicles, but typically just your real estate and the amount of cash that you have sitting in your bank accounts or maybe even in your house. Although I don't know if I have cash sitting in my house. I don't recommend that. So that's pretty straightforward. Section 3, analyzing what assets do you have, namely your equity. Section 4 is if you're self-employed. Again, this form is only for sole proprietorships like if you have a business that you're reporting on your Schedule C or E, then you go put this business information down. What is the name? What's the EIN? What type of business is it? Section 5 and Section 6 go into an analysis of the business. So similar to the assets that I analyzed for the personal level, what assets does a business have? Does it have cash? Does it have bank accounts? Does it have digital assets? What other assets does it have, like equipment? Here, things like, things that the business might own in terms of equipment and inventory or whatnot. This is more important than it is on the personal level. So like I said, the IRS isn't super interested from what I can tell if you as an individual own this or that jewelry or trinket or furniture, but the IRS would have more interest in, does this business own a lot of equipment that could be sold and has a decent fair market value? Some businesses own a lot of machinery that could be worth a lot. So here, unlike the personal analysis, this section is more significant and relevant. So I would take a little more care. And, does the business have notes receivable, accounts receivable, etc.? Section 6, it goes into a deep dive of the business income and expenses, and it's pretty straightforward. What is the business income? What is the business expenses? Business gross receipts, rental, interest, etc., etc. And what are the business expenses? You can use a profit and loss statement. In my experience, I prefer to use the tax return just because it has, I go to the personal return and I pull the Schedule C and I look at it just because it has all of the information gathered in one document and one schedule. And it's fairly straightforward to organize and present to the IRS. That having been said, if you want to use a profit and loss statement, you do you, right? It's whatever works for you, however is the best way to present information in an organized, simple fashion. Whatever it is that you submit to the IRS, my take, and I think others would agree with me, is the simpler you can make it, the better. So whatever you can do to help them digest it quickly and easily, that should be your focus on in terms of your style. So once the business has been analyzed, the sole proprietorship has been analyzed in terms of its equity and its income, then here we go, Section 7, we circle back to the personal level, monthly household income and business and expense information. So here we analyze the taxpayer and their spouse, again, if they're married, what are their wages? Do they have income from Social Security, pensions, other income? Here you can see, maybe do they have interest, dividends, royalties, distributions? Here's the section to put the net business income that you calculated in the earlier section, Section 6. Do you get child support? Do you get alimony? Add all of that up, that's your total household income. Then here we go, Section 7 continued, just the monthly household expenses. Again, these categories of expenses are really straightforward. Food, clothing, housing, vehicle, public transportation, health insurance, etc., etc. Broadly speaking, it depends on the category, but broadly speaking, the IRS has come up with a series of national collection standards that it imposes for certain categories of expenses. So for example, food, clothing, housing and utilities, vehicle. If you click on this hyperlink here that I'm hovering over, it'll take you to the IRS website that breaks down what the average in the IRS's mind and calculation. What should be the average expense incurred for a specific family of a specific size in a specific geographic location. And that's the standard that the IRS allows for that expense. So again, it depends on the geographic region. Some standards are just broadly speaking national. Some standards are much more localized and granular. So food, clothing, and miscellaneous, it's just one national standard. But obviously things like housing, it has to be broken down by geography, because if you live in Hawaii, cost of living there is really different from when you live in Wisconsin. So you just have to look at the state, look at the county, and the household size. If you, for whatever reason, exceed those standards, it's not automatically disallowed, but it is incumbent upon you as a taxpayer to provide a decent explanation and substantiation for why you should be allowed to claim above that standard. So here you have your income, you have your expenses. The delta will then generate the monthly net disposable income and the monthly net disposable cash flow. And then based on that, now that you've done your analysis of the sole proprietorship and the individual household, you come up with your offer. So here there are two different calculations presented. You have to choose. And this pulls from box F. So if we back up, box F here is how much is your monthly net disposable income. And recall what Zoha had said previously about there being two types of offers. You can choose the lump sum, which is much shorter in terms of timing, or you can choose the periodic, which is longer. So lump sum is 5 or fewer payments within 5 months. Periodic is wrap it up, have the offer paid off within 6 to 24 months. So the first one, take your monthly net disposable income times by 12, lump sum. Second one, take your monthly net disposable income times by 24, that's periodic. This is the IRS's projection of your future remaining income. Then we're going to back up here. Box A refers to available individual equity and assets. So this box just had you go back to section 3 and add up all the equity that you had. What's in your bank accounts, what's in your retirement, what's sitting, what equity do you have in your house and your cars, add all that up. That's box A. And box B is the equity for the business if you have a sole proprietorship. If you don't, you don't. So then you take box A and B, if applicable, add up that equity, and then you add it to the projected future cash flow, and that is the basis of the offer. The offer has to be more than 0. I've had people tell me that they've submitted offers for as low as $10. So it just has to be above 0. And then lastly, here you see section 9, other information. Well, technically not lastly, but towards the end, you see section 9, other information. And these are just a series of questions that the IRS determines is relevant to its analysis of your offer and you. And they have to do with things that are very relevant to collection potential, like do you have bankruptcy in the past? What is your litigation history, if any? Are you the trustee, fiduciary, contributor of a trust? Do you have a safe deposit box? Have you lived outside of the United States in a foreign place for a while, et cetera, et cetera. Section 10, you sign under penalty of perjury. And then here, all the way at the bottom, you have a pretty handy dandy checklist where the IRS is organized like you should attach the attachments here that are applicable to you. Not everything's going to be applicable. These are pretty straightforward, recent pay stubs, recent statement for investment and retirement, recent statements for your sources of income, like pension, social security, rental, etc. Bank statements for 3 most recent months, 433B, if applicable, so on and so forth. So that is the 433A. We're going to move on to the 433B. The 433B has an identical analysis. It's just done for the business that is not a sole proprietorship. So I'm not going to spend as much time going over this. It's pretty much the same thing that you saw in the 433A. It's just for corporations, partnerships, LLCs, or other LLCs. So here you can see section 1. What is a business? Identify it, provide its indexing information, the nature of its business. Here you provide all of the information about partners, officers, members, major shareholders. Who are they? Their indexing information, contact information. Section 2, again, business asset information, cash, bank accounts, retirement, digital assets, notes receivable, accounts receivable. Section 2, continue. Does a business have real estate or vehicles? If so, what is the equity? And other business equipment, like I talked about. So box A, again, this adds up all of the available equity. We went through bank accounts, cash, real estate vehicles, add all that up, add it up here. Section 3 is business income information. Again, you can use a profit and loss statement. My preference is to use the tax return because the work has already been done. I will say if the most recent tax return, the financial information on that is significantly different from the current state of the business. So it's 2025. The most recent return available is 2024. If in 2024, the business was doing extremely well, but now in May of 2025, the business is not, then it would make more sense to use the most current profit and loss statement. So here, business income, pretty straightforward, gross receipts, rental income, dividends, business expense. What are the materials provided, inventory purchase, wages, salaries, rent? What is the delta between those two? And that brings you to the remaining monthly income, the net disposable income of the business. Again, you have your offer that you have to calculate. Are you going to do lump sum or are you going to do periodic? Take the monthly net disposable income of the business, box D here, plug it in, do your analysis. This is a projected future remaining income. the amount from box A, which is the total available equity in the business assets overall, put that in, add it to E or F here. That is the basis of the offer amount. Again, the offer must be more than 0. Then, as you can see, we have more information here. It has to do similarly with, have you filed for bankruptcy? Do you have litigation history? What are the business affiliations? This is just a questionnaire that has to do with the business that is relevant to the IRS's collection potential analysis. And more information here, sign here. There's a helpful checklist here that the IRS has compiled saying, go down this checklist. Do you have all of these attachments if they apply to you? Then the last form we'll go through before we pivot to Comptroller OIC processes is the Form 656. And this form is the actual offer and compromise itself. This is where you just tell the IRS, okay, this is just my offer. Fill in the taxpayer information if they're individuals, individual tax periods for which you owe and that you're claiming the compromise for, the offer for. Low income certification, like Zoha had said, low income certification, there are certain advantages. If you qualify as low income, you don't need to pay the application fee, you don't need to pay the initial deposit or continue to make payments while the offer is pending and under review. So this goes through the low income certification process. Section 2 is, are you a business that is filing the OIC? If so, what is your information? What are the tax periods for which you owe? And then section 3, what is the basis of this offer? Data collectability, effective tax administration, economic hardship, or public policy. Check that. Section 4, payment terms. Are you choosing lump sum or periodic? Fill in those terms and those figures. And then section 5 is just how you want your payment designated, if you do want to designate it. Section 6 is just where you're going to get the money from, and it touches on your filing and payment requirements. And then section 7 goes through your offers, the offer terms and conditions. And then here you sign, your attorney signs here, and then you submit this. So that's the form 656. Again, we're not going to go through the 656L because that's for the offer and compromise status liability, and that's just not a really prevalent offer that we often submit. So now that we've gone through the major forms, the forms that you use for the federal IRS OIC, we're going to pivot to the Maryland OIC here towards the end. And Maryland, the comptroller, like the IRS, has the OIC program, and this is used to resolve tax liabilities with the comptroller when the taxpayer cannot pay it in full, and all other efforts to resolve it have been unsuccessful. This is available for all taxes, and it should not be used to appeal the taxpayer's liability. Under this program, the comptroller will, like the IRS, look at the taxpayer's available resources and consider them in light of the taxpayer's circumstances and arrive at a fair solution by considering a reduction or abatement of the amount due. Requirements are there has to have been an actual delinquent tax liability that has resulted in an assessment, and the taxpayer has to have exhausted all other avenues of administrative appeal. So you cannot do an offer if there are any issues remaining that can be appealed. The offer balances must be ripe. 2 years must have passed since the liability arose, and the taxpayer must be current with respect to all returns filed or required to be filed. They must not be in open bankruptcy, and they must be unlikely to be able to pay in full any time in the foreseeable future due to the taxpayer's financial situation, and be either without resources or unable to apply present and/or future resources to paying the outstanding liability. How do you apply? Similarly, the comptroller has the Form 656 and 433A. They're just Maryland forms, not IRS. But it should come as no surprise that the financial analysis is essentially identical. And the comptroller prefers electronic submissions, so email it to this email address here, or you can submit it via snail mail to this physical address here. I will say I have emailed it, and I was very happy that the email went through because it was so voluminous, but it went through. They confirmed receipt. That made me very happy because I definitely had a connection sending.
I still remember the time when they didn't have that email. So I think it's a great change. I love that.
Yeah. And like the email said, offer received, confirming receipt. And I was like, oh, thank God. It was so voluminous.
It's a game changer. Yeah.
It is 100%.
Yeah.
So those are Maryland OICs, broad level. I'm going to turn it over to Zoha to wrap up Maryland OICs in this presentation.
Yep. Thanks, Sunny. All right, so just a couple of practice tips, and I'll go back to IRS in Maryland at the same time. So just like IRS, Maryland also lets you file an offer if there's a doubt as to liability, there are insufficient resources, or there is an economic hardship, similar to what we've talked about with the IRS. So for doubt as to liability, if you believe the taxpayer does not owe the amount, you have to include, again, the Maryland 656 form that Sunny talked about, along with a detailed explanation of the reasons you believe the taxpayer does not owe the tax. Exactly the same as you would do for the IRS. Well, if you have insufficient resources, the taxpayer does not have enough assets or income to pay the amount in full, you must include the form Maryland 656, a complete financial statement, Maryland Form 433A, like Sunny said, it's very similar to the IRS. For individuals, 433B for the businesses. If there is an economic hardship, so if the taxpayer has enough assets to pay the amount in full, but they believe that because of their exceptional circumstances, requiring full payment would cause economic hardship, or it would be unfair against public policy, inequitable, you must write an explanation and also include the aforementioned financial statements, the 433A, Maryland 656, or if you're a business, 433B. So it's essentially the same forms, and you'll handle it the same way for like an IRS offer. Just a couple of things I really want to mention here is with Maryland, Maryland offers are they're different the way they're handled from the IRS. IRS OSC program is very different. The way you look at financials, Maryland is different. They're different. Why? Because with the IRS, when you file an offer, your offer actually gets assigned to an offer examiner, and they will negotiate with the taxpayer or their power of attorney directly in order to see what the reasonable collection potential looks like. Maryland is a little different. Maryland, you want to make sure that when you're submitting your offer, it's very comprehensive in terms of all the supporting documents that you want to attach and provide and your explanations, because they're not going to negotiate, or there's not going to be an offer examiner that'll talk to you. They'll review it. They'll either, and let's go to the next slide, Sunny, and we can show that as well. So they can either accept your offer, give you a counter offer, or just decline your offer. So if Maryland, the Comptroller of Maryland, they determine that your offer is acceptable, the taxpayer or their representative, it's usually the taxpayer, they'll be notified that your offer has been accepted, and the instructions for making the final payments pursuant to whatever terms you have written on your Maryland 656 form. If the comptroller determines that there are grounds for an adjustment, meaning that the offer amount that you offered is insufficient, but they can collect more, they'll actually come back with a counter offer. And that has happened to me multiple times where, for instance, we offered $5,000 to settle the debt, and they come back and ask for $7,000, and my client was still very happy, and we ended up accepting their counter offer. So that's a great tool instead of just outright rejecting it because they don't have reasonable collection potential or they can pay it in full. They can actually give a counter offer, and you as an attorney can discuss that with your client. It may still be a great route for them to accept the counter offer and settle the debt overall. If Maryland believes that there's no grounds for adjustment, they will decline your offer and you will get a rejection letter in the mail. Another big difference with Maryland rejecting your offer and with IRS rejecting your offer is IRS offers come with appeal rights. Maryland offers, unfortunately, do not come with appeal rights. That decision is final and it cannot be appealed. Therefore, like I said in the beginning, if you are someone filing an offer with the comptroller for your client, make sure that it's a very comprehensive and a detailed offer, because you do not get appeal rights for your client. Another thing, if an IRS offer gets accepted, that accepted offer goes into an IRS monitoring program, and they're supposed to monitor offers for 5 years, meaning the taxpayer must stay compliant for 5 years after their offer has been paid in full and accepted. Maryland here, as you can see, last point, that Maryland only monitors for 3 years. So once your offer is accepted, you must stay current and in compliance for future filings for 3 years from the date of that acceptance. So that's a little bit of difference. Another thing with Maryland, and I know Sunny mentioned that as well, but with Maryland, there's offer eligibility very different from the IRS. You cannot file an offer with Maryland unless each balance with Maryland is at least 2 years old. So that is something that if you are an attorney and you're looking at whether you should file an offer with Maryland, make sure you get a compliance check done with Maryland. make sure you ask Maryland, the Comptroller of Maryland, to provide you assessment dates for each balance. That way you can analyze whether your client is even eligible to file an offer. Instead of, starting jump right in preparing on an offer, make sure you check whether, their 2 years have lapsed from each assessment. And sometimes it's not. And that means your client is not offer eligible, and you maybe want to put them in a payment plan that can be temporary until your client is actually offer eligible. So what happens, I think we've covered this, what happens after Maryland processes OIC. And I think that might be our last slide, right, Sunny? Can't remember.
Yes, this is the last.
Yeah. Okay, perfect. I think that is it. One more thing that we didn't touch upon, and then we can go open questions. A lot of times there's a taxpayer who owes debt and then they remarry, and there's a non-liable spouse issue. And when you're doing financials, the rule is the same, whether you're doing an IRS 433A or you're doing a Maryland 433A. You have to prorate each expenses based on the income that the non-liable spouse and the liable spouse is bringing. So a question that I get asked all the time, I have a non-liable spouse. I don't want to mention them on the form. Unfortunately, that's not how the forms work. You have a non-liable spouse. They are non-liable, and your attorney can actually write on the form that they are a non-liable spouse. But you have to disclose their income, because if you both are living together, IRS or even the Comptroller of Maryland look at a joint household income. So you will mention their income, your joint expenses, and then you'll prorate each expenses based on your monthly income ratio. And that's how IRS will determine what your reasonable collection potential is. Again, if there is a non-liable spouse, you are a tax attorney trying to review whether your client is eligible, I highly recommend that you do that proration in your eligibility time to figure out whether it even makes sense, whether the client has reasonable collection potential. Because of that non-liable spouse, if the non-liable spouse earns more, it can kick someone out of that reasonable collection potential. It just all depends on everyone's financials. But yeah, that was it from our end. I know it was a lot of information. We might be a little too fast because we had to cover everything in 1 hour, but feel free to ask questions. If not, you will have our email address and you can always reach out to us. Thank you.
I see some questions in the chat. So, first one, should you go to see a tax advocate before you file an OIC when you have more than 5 years of tax debt? I think the Taxpayer Advocate Service, TAS, I think it's for really specific dysfunctions that you might have with the IRS. You filed something and you haven't heard back and it's been way too long and the delay is unacceptable. You need TAS to help push it through. So I don't know if you would need to escalate it to TAS to file an OIC, and because think about it, like you could have like 10.
I mean, TAS will not help you file an OIC, but it depends if you've already filed something with the IRS. There's a delay and it's causing you hardship, and that's when you reach out to a taxpayer advocate.
But just having
Yeah.
just having more than 5 years of tax debt, I don't think that necessitates a conversation with TAS about whether you should file an OIC. If you have more than 5 years of tax debt, go ahead. I mean, you can file an OIC if you have 1 year. You can file an OIC if you have 10 years worth of balances.
Yeah, as long as you're eligible. Yeah. And I think the next question, how do you handle joint expenses if only one spouse owes there? I think I answered that towards the end, that if there is a non-liable spouse, that should be reported on the 433A, and you will just have to prorate each expenses.
And I think how you prorate it is, it depends on how much money you made.
Yeah.
Whoever
yeah,
makes
absolutely.
more gets to claim more expenses.
Correct. Yeah.
Other question, how do you go about determining what term period a client can pay the tax liability? Do you always come to the 433 and see the outcome? What if the taxpayer won't be able to pay in 10 years? How do you go about determining what period they can pay the tax liability?
I'm not sure I understand the question.
Yeah, what if you can't pay in 10 years? If you, in terms of your income, projected income, will not be able to pay off the total balance due to the IRS before the expiration of the statute of limitations, then I would say you are OIC eligible. If you can pay off everything before the statute of limitations expires, whether it's 10 years or shorter, then you are not OIC eligible. So how do you go about determining what period you can pay the tax liability? Yeah, do the 433 and see what their numbers.
Or Sunny, I would like to add, like for at least what I do for my offers, if I don't even know my client is eligible, I don't want to fill out and spend their legal fees and finishing a full 433A. You can get all that information and like do a quick, like an Excel spreadsheet analysis to even
Oh, yeah,
see
you do like a
whether
quick
they've
and dirty, yeah,
quick and dirty,
yeah,
and then you can have that honest conversation with your client, whether you're a good candidate or not. But either
Or,
way, if you fill a 433A, you still need a 433A for a payment plan at the end of the day. So if you're not offer eligible, you can use the same 433A to get them on a payment plan.
yeah.
So it kind of works out.
Or they can use that, the IRS, one of the forms, I think it's the 433 or the 656, has a link to the IRS website that takes you to the pre-qualifier tool, where
Yeah,
the taxpayer can just kind of do it themselves and get like a rough idea of whether or not they're a good candidate and whether or not it's worth undertaking this procedure. And, you know, the IRS also specifies use of the tool does not determine acceptance if it says you're qualified, but it's a helpful tool to see, like, is this even worth it? But again, broadly speaking, if it is reasonable to think, based on your situation, that you can full pay the liability before the statute of limitations expires, you're not OIC eligible. What about when the taxpayers live in different states? How do you allocate the expenses? Like a married couple living in different states?
Could be.
Yeah. Well, Zoha, correct me if I'm wrong, or anyone, if on these 433s, you can only claim expenses for one actual physical residence.
Yes, but some people can have complicated situations. So
Oh, yeah.
I've had a case where
Military?
so it also depends whether it's a joint liability or a single liability. So if both the taxpayers are married, they file joint and the liability is a joint liability, even if they're living in different states, you could explain. It depends how the IRS handles it. It can be very hard. But if they have a joint liability and they're in different states, depending on how much they're earning, you can. Or you could actually do, depending on, like, you can actually separate their expenses based on their income. So if if they have no joint expenses, one person's in, I don't know, California, and they're earning there, they're keeping their income there and paying their bills, and the second spouse is also doing it. So it just really depends on facts. I don't know all the facts, whether the liability is joint or whether the liability is separate. But you can explain, especially if it's very complicated, where you do have a joint liability. I don't see that often where they have a joint liability. I see people living in separate states, sure, but there's always a non-liable spouse among them.
If it's truly necessary to live in separate states, you can argue for it. But I had a case recently where the IRS was like, and it was a joint balance. This was not an OIC, it was just a payment plan. But the IRS was like, sorry, man, we straight up say on the 433A, we don't allow expenses for more than one physical residence. So, you know, I guess if there's a really compelling reason that you have to live apart and incur those double expenses, yeah, go ahead and argue it. You know, my philosophy is pretty much throw it all at the wall, be zealous and see what sticks, right?
You can try.
In good faith, of
It
course, in
depends
good
how the
faith.
IRS will handle it. Yeah. Because
But
they're different. Like every examiner, whatever examiner you get can handle it in a different way. So it's just something that you'll have to kind of argue with the IRS. Yeah.
it's an uphill battle, though, claiming dual household expenses. I will say, from what I can tell, it's kind of an uphill battle.
Yeah, for sure. Absolutely. All right. John, have you covered all of the questions or?
I think we did.
I believe so. Yeah.
Okay. I think that actually there's one more question. Someone said, what if you have roommates as a single person? How are expenses reported? Well, living with a roommate is different than living with a non-liable spouse. So you would then actually have to explain to the IRS that you are just living in a place where you're renting a room and you have other roommates that have nothing to do with you. So therefore, you would just claim your portion of your expenses, what you're paying for housing, rent, etc.
Yeah, you can't claim everyone's expenses if you're only just paying your own. And I would argue it's a similar philosophy if you are married to someone, right? Like it's a prorating thing.
Yeah, but for when you're married to somebody, you have to include their income because they're your spouse.
Yeah.
But for your roommate, you don't have to disclose your roommate's name or their income on the 433A. Doesn't matter. Yeah, I think that should be it.
Good stuff.
Did you guys get to the questions in the Q&A section?
I believe so.
Okay.
We did, Katie.
All right.
We just had pulled that up and we were kind of reading through the questions.
Okay. Just wanted to make sure that J Block got his application fee question asked because he did raise his hand again.
Sure. What is the question? I don't think I see that question.
So it's not in the chat, in the actual Q&A section.
Oh, I
So
don't have that
Oh,
section.
I
I'm sorry.
see. Yeah, okay. First question, anonymous. We have had more success with currently not collectible status, pros and cons. Currently not collectible status, I think that that is tougher to argue for than an OIC because currently not collectible. There's two types, oddly enough, due to financial hardship, not due to financial hardship. Not due to financial hardship, from what I can tell, has to do more with the fact that the IRS simply cannot locate you or your assets, so they've kind of given up and put a pause. And that's like it's a soft, currently not collectible. We call it CNC. CNC due to financial hardship is it's been obtained before, but it's typically like I'm unemployed, or I am employed, but I'm the only one that works, and me and my family, we have crazy expenses because one of my kids is really sick and he has humongous medical bills. We're thinking about filing for bankruptcy. So, CNC, I would say, is harder to get than an OIC, broadly speaking. One of the huge advantages of CNC due to hardship is the IRS pauses enforcement, but the statute of limitations continues to run and run and run. And
to add that, you're still accruing interest. So I feel like CNC is great for someone who just needs a break from the IRS. It's temporary, but they are planning to pay the IRS because CNC gives you a break from the IRS only for 2 years. As long as you stay current with your filings in those 2 years, you won't get kicked out of the CNC status. OIC is, I don't even know if I want to compare CNC with OIC. OIC is a tool that actually gets you rid of your entire debt if you're eligible. So it really depends. If you're not eligible, but you're facing a current hardship, you've lost your job, but you're going to find a job that's going to be bringing in good money, then you have a current hardship and CNC would make sense. But OIC is really where it's for the longevity, where you're really just getting rid of the debt. CNC will still accrue interest.
Yeah. OIC, one of the benefits of it is you resolve your debt a lot faster and you don't have to look back.
Yeah.
Next question, is the $205 application fee required for OIC doubtless liability? Yes.
Yes.
Last question, 433 OIC does not appear to work for taxpayers with a businesses and or rental property. What 433 form is needed for OIC taxpayers with businesses or rental properties?
I love this question.
Rental property is 433A OIC. If it's on a Schedule E, do 433A OIC. Multiple businesses. If it's a sole proprietorship, it goes on a 433A. If it's not a sole proprietorship, it goes on a 433B. You have multiple businesses that are not sole proprietorships, just do multiple 433Bs. Rinse and repeat.
Or attach addendums. That's what we do when we are preparing OICs for our clients who have multiple rental properties. Not everything can go on this form, so we attach a lot of addendums to each form with spreadsheets if needed, because a lot of my clients will have multiple cars or multiple rental properties, and you want to identify which one's bringing income, which one's their personal residence. So you can attach more pages to your 433A explaining the type of income and assets you have. And these are, they look easy, but there's a lot of work that goes into these forms for sure.
Yeah, the 433s, they can be a lot. Full disclosure, they can be a lot. I'm a lot more comfortable with them, but I do it for a living. But for people who it's a one-off thing, it's a lot.
Yeah. I think now we've covered all the questions. Katie, I had no idea about this chat box, so I apologize.
Oh, no, you're fine. I think we are good now. Just double check.
Yeah.
Okay, yep, that looks like everything. So thank you to our speakers for joining us today, and thank you for
having us.
Of course. Thank you for having us.
Yes, always. And just a quick reminder for our attendees, please complete the evaluations if you have time. That will pop up on your screen once the webinar is closed. We always value your feedback and look, excuse me, and always look to provide better experiences for you in the future. Thank you and have a good day, everyone.
Thank you so much.
Thank you.
I really enjoyed
Bye,
this.
everybody.
I really appreciate the opportunity. Bye, everyone.